Needs insurance, whether it's auto insurance to protect us when we're on the road, or homeowners insurance to protect the biggest investment for most families, or life insurance to cement your family's financial security in the event of a tragedy. It's our job to make sure that the industry is protecting Americans' hard-earned money, not putting it at risk. American insurance companies are regulated by state insurance commissioners. We know that. The state-based system of insurance regulation is historic and ensures that local markets and needs are taken into consideration. The National Association of Insurance Commissioners, NAIC, coordinates state commissioners across all jurisdictions to identify and address risks to the entire system. In the Wall Street Reform Act, Congress created a few years ago, a decade or so ago, Congress created the Federal Insurance Office within the Treasury Department to promote national coordination in the insurance sector. It's common sense. Insurers operate across all state jurisdictions and internationally. I'm pleased to have both the Maryland Commissioner, Kathleen Birrane, on behalf of the NAIC, and Director Seitz of FIO testify today. Thanks for your public service on all levels. If we're going to keep Americans' hard-earned money safe, it's more important than ever that they work together. We'll explore many topics today. For example, 3 months ago, Lockheed Martin transferred $4.3 billion of its pensions to Athene Holding, an insurance holding company specializing in life insurance and owned by the private equity firm Apollo Global Management. Overnight, Lockheed Martin employees and retirees were notified that their pensions would be managed by Athene and no longer governed by ERISA or the Pension Benefit Guaranty Corporation. Many employees are very exceptionally nervous about that. It's one recent example of private equity giants' expansion into people's pensions and into the insurance industry. We know that workers end up worse off when Wall Street private equity firms get involved. We've seen it over and over in industry after industry. In March, I asked NAIC and FIO to look into private equity's expansion into similar pension risk transfer transactions. We need to understand the risks to workers whose financial service depends on pension and retirement programs. NAIC and FIO provided thoughtful responses to my letters. Thank you for that. NAIC has been monitoring the risk-taking behavior of private equity-owned insurers. FIO has done similar work and also looked at the wider interconnectedness of insurance and reinsurance markets across the world. Those connections have added to systemic risk concerns because U.S. insurance companies depend even more on the financial health of insurance companies outside the U.S. Taken together, our insurance authorities are focused on these emerging and complex risks to safeguard our economy. Our communities, our families rely on insurance companies to protect their loved ones, their homes, their small businesses, and so many parts of their lives. We can't ignore when risks build up or firms behave irresponsibly. We know who always pays the price when they do. It's rarely insurance executives. It's not Wall Street. It's not private equity executives. It's workers and families. It's taxpayers who were forced to bail out AIG a decade and a half ago. That should never happen again. It means looking around the corner to make sure industry and agencies are prepared for risks as they develop. As more Americans face increasingly severe climate catastrophes, wildfires, hurricanes every year, we need to help communities prepare, and we need to ensure that insurance watchdogs and the companies they oversee are also prepared. In the aftermath of some of these natural disasters, we've seen instances where insurers either raise prices or actually stop offering insurance altogether, leaving families, leaving businesses struggling to find affordable coverage as they work to rebuild their lives and rebuild their communities. We know this industry has a long history of racial discrimination, just like so many other big industries. Black and brown families face more difficulty across the board in getting insurance. We've seen this happen in auto insurance. Particularly earlier this year, the New York Times reported that customers, insurance agents, and employees sued State Farm for discrimination in the workplace and in paying out claims. My colleague, Chairwoman Waters in the House, has been working on learning more about this as well. Her committee recently requested information about large life and P&C insurers' involvement in financing chattel slavery. I'm glad FIO and NAIC are also working on this, and NAIC is investigating through its Special Committee on Race and Insurance. I look forward to reviewing FIO's upcoming report on availability and affordability of auto insurance. I hope it will shed more light on racial equity in assessing this insurance and accessing this insurance. Finally, later this year, the International Association of Insurance Supervisors will need to consider whether the U.S. insurance system's review of capital adequacy standards meets international criteria, because we regulate insurance differently in the United States, where state and local markets, international markets are served by the same companies. It's important that representatives of the U.S. system, like you, like FIO, like NAIC, advocate for fair treatment by international regulators. And now that the Fed Vice Chair for Supervision has been confirmed, Michael Barr and the offices testifying here today will get to work with international counterparts in this process. All these issues show how critical the work that you two do is to our economy's health and stability. I expect FIO and NAIC to prioritize monitoring these risks in their ongoing work. Senator Toomey.
Thank you, Mr. Chairman. Welcome to our witnesses. It's been a while since our committee has held a hearing on the insurance industry, and so I welcome the occasion this morning. There are a few topics in particular I'd like to touch. For the past 150 years, when it comes to insurance, the federal government has a very extremely limited regulatory role, and I see little need to expand that. The system works well for consumers and for the industry. And that's one reason we need to pay close attention to efforts to develop and implement international insurance standards by international bodies. In particular, I worry, and I'm not alone, that the Insurance Capital Standards, or the ICS, currently being developed by the International Association of Insurance Supervisors, is incompatible with the U.S. insurance market. There's widespread concern that the ICS is too sensitive to short-term fluctuations in markets and certain asset categories and does not take into account certain aspects of the assets that insurers hold. The result is that the implementation of ICS in its current form would harm the availability of long-term insurance products that Americans rely on for financial security. Our U.S. representatives at IAIS need to make sure that ICS works for the U.S. market, and by not allowing the proposal to go forward until it does. Next, I'd like to touch on some troubling efforts to use our financial system to address climate change. Now, there are some liberal activists who want to pressure insurance companies and other financial institutions to deny services to traditional energy companies and other carbon-intensive industries. Such efforts are profoundly misguided. Addressing the difficult challenges posed by global warming requires political decisions involving important trade-offs. We've seen those trade-offs in action in recent months. Soaring energy prices, European nations have made plans to reopen coal power plants and extend the lives of nuclear plants. Likewise, in the U.S., we've seen the Biden administration's hostility to new energy production contribute to shockingly high gasoline prices. That's a painful consequence of policy choices. In a democratic society, those choices and the trade-offs associated with them must be made by elected representatives who are accountable to the American people, not unelected activists, bureaucrats, or insurance executives for that matter. To be sure, insurers face financial risks in the form of natural disasters. After all, that's a core business of the property and casualty insurance industry. Insurers must be allowed to set premiums that accurately reflect these risks. And to the extent that climate change exacerbates these risks, then they're going to need to adjust their prices accordingly. Higher premiums are an important signal to policyholders that warn of increased risks of fire or flood or earthquake or other peril. Further, they create a financial incentive to mitigate risk, which leads to safer and more resilient communities and society. Bottom line is that a well-functioning insurance industry is quite capable of addressing the natural disaster risks that it faces today and in the future. I'd also like to address plans to create a federally guaranteed pandemic risk insurance program. Excuse me. As proposed, this program would be akin to the Terrorism Risk Insurance Program, or TRIA. As a reminder, TRIA mandates that insurers offer terrorism insurance, and in the event of an attack, the federal government bears an increasing share of the cost of claims depending on the severity. Well, a similar program for pandemics would be very, very problematic. First of all, it's hard to imagine that insurers are well equipped to quickly distribute hundreds of billions or maybe even trillions of federal dollars. Recall that in a matter of months, the Paycheck Protection Program distributed over $500 billion via the banking system, but banks and other financial institutions participated on a voluntary basis. Compare that to the disastrous claims processing after Superstorm Sandy. But more importantly, a federally guaranteed pandemic risk insurance program would encourage state and local governments to impose economically devastating shutdowns in the future. Such a program would in fact incentivize state and local policymakers to quickly impose lockdowns with their jurisdictions with the assurance that the federal government risk insurance program will bail them out. Instead of considering policies that will facilitate future lockdowns that repeat the mistakes of the past, we should be thinking about future mitigation measures that don't crush business, workers, and the economy and don't harm our children's educations. Let me conclude with this observation. A well-functioning insurance industry is a critical component of economic prosperity and financial security for all Americans. Everyone will be better off if we resist activist efforts to use insurance as a tool to pursue social policy goals. Insurance is not a legitimate tool, as some have suggested, to decarbonize the economy, to infringe on Second Amendment rights of law-abiding citizens, or to mitigate wealth inequality. Let's have insurers stick to the business of insurance. I look forward to discussing these issues today.
Thank you, Senator Toomey. I'll introduce today's witnesses, and then they'll begin their testimonies. The Honorable Kathleen Birrane is the Maryland Insurance Commissioner, testifying on behalf of NAIC. She previously was a partner at DLA Piper and principal counsel of Maryland Insurance Administration in the Maryland Office of the Attorney General. Mr. Stephen Seitz is director of FIO at Treasury. He joined FIO as deputy director, previously worked at the Office of the Assistant General Counsel at Treasury and the CFTC. Welcome to both of you. Commissioner, please begin your testimony. Thank you.
Chairman Brown, Ranking Member Toomey, members of the committee, thank you for the invitation to testify today. I'll use my time today to touch briefly on several issues we know are of interest to members of the committee. First, we have been actively monitoring the growth in private equity-owned insurance. Our solvency framework includes significant checks and balances to protect policyholders, including public disclosures, capital requirements, and conservative accounting requirements, which are used to assess all risks to insurers, regardless of the type of ownership. As insurers of all types are searching for investment yield to avoid raising prices, insurance regulators are reviewing existing guidelines and considering new requirements to ensure our ability to assess and address the risks to policyholders. The NAIC is working with 13 regulatory considerations applicable to both private equity-owned insurers and other insurers with similar features. We have extensive data reporting and analytical capabilities to review and assess alternative investments or unique structures and are continuing to refine those tools. We are confident in our system to appropriately oversee insurers no matter how they are structured, and we will certainly keep the committee apprised of our work in that regard. Next, insurance regulators also recognize the importance of cybersecurity risk management and continue to upgrade data security safeguards. The NAIC's Insurance Data Security Model Law updates regulatory requirements relating to data security, the investment of a cyber event, and the notification to state insurance commissioners of cyber events. States continue to adopt the model, which now covers 83% of the market as measured by gross written premium. The NAIC also created a new Innovation, Cybersecurity, and Technology H Committee, which I chair, to address the insurance implications of emerging technologies and cybersecurity and to ensure coordination and consistency among insurance regulators. The NAIC also continues to facilitate tabletop exercises with insurers, regulators, and law enforcement to explore cyber incident response. Another top priority is climate risk and resilience. This year, the NAIC facilitated revisions to its Climate Risk Disclosure Survey, which is now aligned to the FSB's TCFD. These disclosures, now covering 80% of the market by premium, help insurance regulators assess insurance industry risks and actions to mitigate climate risk. We also monitor insurers' ability to pay claims following catastrophic events. We recently recommended that wildfires be explicitly added to the risk-based capital framework for catastrophe risk exposures. Further, the NAIC is creating a catastrophe model center of excellence to provide insurance regulators with access to information and training on catastrophe models. Another area of activity for state insurance regulators is the intersection of race and insurance. The NAIC's work focuses on evaluating issues of race and diversity within the sector and addressing market access and potential barriers. Additionally, the NAIC formed a New Avenues to Insurance Careers Foundation to help foster interest in the insurance careers with a focus on students from underserved and diverse communities. Turning to the international front, state insurance regulators continue to engage on a variety of issues, including the IAIS's development of an insurance capital standard. The NAIC, along with our Team USA partners, including FIO, have been clear that the ISC does not work for the U.S. market or our supervisory regime, and therefore has developed an aggregation method as a comparable alternative to the ICS. We will continue to advocate for recognition of the U.S. approach to group capital within the IAIS, and is already reflected in covered agreements between the U.S. and the EU and UK. Finally, we would like to highlight a few of our federal priorities. We urge Congress to pass a long-term NFIP reauthorization that encourages investment in flood mitigation efforts. And we support Senator Scott's Primary Regulators of Insurance Vote Act, which would provide state insurance regulators with a vote on FSOC. We are also working on legislation to help protect policyholders during an insurance receivership. So thank you again for the opportunity to testify, and I'm pleased to take any of your questions.
Thank you, Commissioner. Director.
Chairman Brown, Ranking Member Toomey, and members of the committee, thank you for the opportunity to testify today about current issues in insurance. I am the Director of the Federal Insurance Office within the U.S. Treasury Department. I would like to begin by briefly outlining FIO's role and responsibilities and by describing some of our current priorities. The United States is the world's largest insurance market, and its insurers provide a diverse range of products to support the needs of consumers and businesses in the United States. The U.S. system of insurance regulation is primarily state-based. However, FIO has a significant role to play as reflected in its statutory duties and authorities. FIO advises the Treasury Secretary on major domestic and prudential international insurance policy issues, develops federal policy on international insurance issues, including representing the U.S. at the International Association of Insurance Supervisors, administers the Terrorism Risk Insurance Program, monitors the extent to which traditionally underserved communities and consumers have access to affordable insurance products, assists the Secretary in negotiating covered agreements with foreign jurisdictions, and monitors the insurance sector, including identifying issues or gaps in the regulation of insurers that could contribute to a systemic crisis. As FIO's director, I also serve as a non-voting member of the Financial Stability Oversight Council. These authorities reflect the need for FIO to provide a national federal perspective in this critical area. I would like to highlight 5 current FIO priorities. Climate-related financial risk is a top priority for our office. We are focused on 3 areas which are consistent with President Biden's executive order on climate-related financial risk. First, FIO plans to publish a report assessing climate-related issues and gaps in the supervision and regulation of insurers. Second, FIO is evaluating the potential for major disruptions of private insurance coverage in U.S. markets that are particularly vulnerable to the effects of climate change. Third, we are increasing our engagement both domestically and internationally on climate-related financial risk issues. As we move forward with these efforts, we will also seek consistent, comparable, and granular data to increase our understanding of the risks from climate change to policyholders, insurers, and the financial system. A second focus area for the Federal Insurance Office is the growing role of alternative asset managers, such as private equity firms, in the U.S. insurance sector. This evolution is one that our office has highlighted for several years. It warrants increased attention to ensure that regulatory mechanisms are appropriately designed to address the activities and market developments that we outlined in our recent letter to Chairman Brown. We encourage continued focus and increased progress by state regulators in this area. FIO will continue to prioritize 4 areas of research and action on this topic. First, liquidity risk. Second, credit risk and capital adequacy. Third, offshore reinsurance implications, including the increased interconnectedness between the U.S. and Bermuda insurance markets. And fourth, potential conflicts of interest. FIO is also focused on cyber-related risk, which is a top priority for Treasury and the entire federal government. FIO has been examining insurers' own cyber resilience, as well as the development of the cyber insurance market. We have increased our data collection in this area with regard to the Terrorism Risk Insurance Program and have supported the development of Treasury's counter-ransomware strategy. We are also working with the DHS's Cybersecurity and Infrastructure Security Agency in connection with GAO's recommendation that we jointly assess the need for a federal backstop for cyber insurance. FIO is also coordinating closely with the White House Office of the National Cyber Director on these issues. A fourth priority for FIO is our representation of the United States at the IIS in close coordination with the NAIC, the states, and the Federal Reserve. In addition to its focus on climate, private equity, and cyber, the IIS is also considering other important topics such as the development of the insurance capital standard and the related comparability work involving the aggregation method, as well as the implementation of the holistic framework for the assessment and mitigation of systemic risk. These topics are important global initiatives that will affect the U.S. insurance sector, and it is critical for FIO and the United States to remain engaged at the IIS on these issues. Fifth, and finally, FIO is prioritizing its work on diversity, equity, and inclusion. Consistent with our statutory authorities, FIO looks at these issues through the lens of the availability and affordability of insurance products, particularly for traditionally underserved consumers and communities. Right now, we are working to update our study on personal auto insurance affordability. Additionally, these issues are also key components of our upcoming climate work. On all of these topics and many others, FIO values our close relationship and frequent coordination with state regulators, the NAIC, our federal partners, and international counterparts, as well as with insurance industry stakeholders. Thank you again for the opportunity to testify today.
Thank you, Director. Thank you, Director, for FIO's response to my letter earlier this year about private equity's growing role in the insurance sector. You mentioned that once a company transfers its pension obligations in a pension risk transfer, the PBGC guarantee no longer applies. Participants would lose protections under ERISA. You reemphasize that. Thank you. What new problems, two questions, what new problems arise from these practices where pensions are transferred to life insurers, and how do they pose risks to workers without ERISA and PBGC protections? And do you have, I guess, three questions. Do you have additional concerns for the broader financial system, its impact?
No, thank you, Senator Brown, for that question. We share your interest in the importance of this topic. The U.S. insurance sector, and particularly the life and retirement sector, is critical for millions of working Americans that are relying on these products for their retirement security. In our letter, we highlighted the four key areas that we're focused on. First, enhancing FIO's monitoring of the potential liquidity risk of the entire life insurance sector, but also particularly related to PE-owned insurers. Second, we're looking at regulatory mechanisms and whether they are appropriately designed for issues related to credit risk and capital adequacy to accommodate and appropriately regulate this type of business model. Third, we are also looking at the offshore reinsurance implications, particularly the increased interconnectedness between Bermuda and the U.S. markets, where certain blocks of business are being transferred offshore. And fourth, we're also looking at potential conflicts of interest. These are important issues for our topic, and we'll be working closely with the NAIC and the states on their focus going forward, and look forward to further updating this committee as that work progresses.
Thank you, and we will ask for that. And my interest in this issue has increased in part because Congress just worked a year ago, worked for several years and was able to fix problems in the multi-employer pension system. We know the human costs that failing pensions pose to workers who earn these benefits and who have that expectation through a lifetime of work. Congress established, as you know, in a bipartisan way, PBGC and passed ERISA. It's imperative that insurers, and we're counting on both of you on this, it's imperative that insurers not be allowed to do an end run around the system established to protect pensioners. Commissioner Birrane, thank you again for being here. I've heard from nonprofit associations reaching out to their state insurance commissioners and NAIC about difficulties finding and affording property and casualty insurance. My question is this: what are the tools available for state insurance commissioners to solve this market failure? And it is a market failure.
So thank you, Senator Brown, for the opportunity. As you know, the NAIC has long opposed the expansion of the Liability Risk Retention Act to allow RRGs to write commercial property insurance. It is our sense that commercial property insurance is generally widely available, and we have serious concerns that nonprofits that are already vulnerable could be put at greater risk from a consumer protection standpoint if they are allowed to purchase their property insurance from an entity that is not subject to the same rigorous standards and multi-state enforcement as admitted carriers, which really creates an uneven playing field. Most states have a residual market for property insurance, including commercial property insurance. I know in my state, I've queried our nonprofits, and this is not an issue that we see in at least the state of Maryland. Other commissioners across the country are making similar efforts to look at their markets to see where issues exist, and we would be happy to know about specific circumstances and make ourselves available to work with nonprofits that are having difficulty getting commercial property insurance.
Your assessment differs a bit from ours. It's a serious problem that hasn't been solved in the marketplace in the past. When faced with similar market issues that span the country, Congress passed the Liability Risk Retention Act. As you know, I'm working to amend the LRA to narrowly address this issue affecting community-based nonprofits. Director Seitz, are you concerned about this gap in the market and ensuring nonprofits have access to the insurance they need?
No, thank you for that question. It's an issue that we've also been tracking, as Commissioner Birrane mentioned. It's an area we've been engaging with various stakeholders on the topic with regard to their ability to get coverage. I think we'll look forward to working with the NAIC and your team as we look into this issue in more depth.
Okay, and count on us to do that. We've been working with NAIC to find a solution. Risk retention groups are regulated by state insurance commissioners under NAIC regulations. And Commissioner, I just wanted to ask again, can we work together to find a solution that responsibly increases insurance capacity for RGs to address this problem?
We absolutely want to work together for a constructive solution for nonprofits who need commercial property insurance, and we're happy to work with you and your staff and with FIO.
Thank you. Count on us for that. And I wanted to ask a third question. I won't take time. My 5 minutes is up, about climate catastrophe risk, and we will submit something in writing, or maybe as part of a second round, or my colleagues, probably one of them, will ask something about that. So, Senator Toomey.
Thank you, Mr. Chairman. The chairman brought up the circumstances that occur occasionally where a pension risk transfer occurs. And my understanding is the nature of this, what we're talking about here, is when a company has a defined benefit obligation to its retirees, it can purchase an annuity, essentially, from an insurance company, which then transfers the management of this to an insurance company. And as the chairman pointed out, in that scenario, it's my understanding that the PBGC guarantee no longer applies. However, there are insurance funds. There are insurance guarantee funds, and so, Ms. Birrane, would I be correct in assuming that the insurance guarantee funds in the various states would be there as a backstop to the ability of the insurance companies to honor their contractual obligation to make those payments?
Yes, Senator, that is correct.
And the transfer itself, so after the transfer occurs, ERISA no longer applies, is my understanding, but the mechanism of the transfer itself is regulated by ERISA. Isn't that true?
That is correct. ERISA no longer applies to the entity that now bears the risk.
Right.
Because what's really happened is that the pension fund is buying an insurance product
Right.
in order to meet
Right.
those obligations.
So then it raises an interesting question. Like, in your experience, Ms. Birrane, I would guess that you'd probably agree with me that insurance companies, especially like life insurance companies, have extensive experience in managing long-term liabilities. Like, that's what they do. So the idea of whether they're in a good position to manage the long-term liabilities of a defined benefit pension plan suggests to me like they are likely to be very well suited for managing that task. Is that your sense?
I would agree, and I'd also point out that they're subject to rigorous financial reporting and oversight, and life insurance annuity contracts are protected by the state guarantee funds, which have themselves noted that insurance regulators hold life insurance companies to much stricter standards and more intensive oversight than are applied by pension regulations to the pension funds themselves.
Right. Now, all those rigorous regulation and supervision that you just alluded to, that doesn't go away if the insurance company happens to be owned by a private equity firm, does it?
No, absolutely not. If anything, private equity funds tend to be subject to stricter regulation.
Thank you. Director Seitz, it's come to my attention that there is work being done on an internal briefing memorandum regarding private equity involvement in insurance, and I'm not sure, you may be involved in that. for the international. I lose track of my acronyms here, but it's the IAIS. Is that true? Is there such a memo being in the works?
No, with regard to the International Association of Insurance Supervisors,
Right, that's it.
they have discussed the topic of private equity, including at its last year's annual conference. There was a panel discussion on that, and it is, I think, I can't disclose the private conversations at the IAS, but obviously it is one of the themes that we're seeing in the macroprudential work being done at the IAS.
So are you involved in an effort to make recommendations to the IAIS regarding private equity's involvement in insurance?
As part of our work at the IAS, we're closely coordinating with the Federal Reserve, the NAIC, and the U.S. states on a variety of issues, including work related to the capital standards and also regarding the holistic framework which the NAIC is adopting.
Okay, but you didn't answer my question. Are you personally involved in research or development of a memo or an analysis that will include policy recommendations to the IAIS regarding private equity and insurance?
Our teams are working closely with the NAIC in the states. I am a member of the executive committee, and there are a variety of topics that the IAS is discussing, and one of those topics at our upcoming meetings will be private equity.
Yeah, so you're obviously trying to evade my question. I don't know why it's such a difficult question to answer. Let me try it a different way. If there is a memo or a piece of research work that is done and you're involved in it and it is submitted to the IAIS, do you intend to share that with the committee?
I think similar to the IIS, we value the importance of transparency at the IIS, and we would work with our state and federal partners at the IIS to make sure that there is appropriate transparency. And this will be a topic that we'll likely include in our upcoming report to this committee that's issued with the Federal Reserve Board regarding our activities in international supervisory forums.
I see I'm out of time, Mr. Chairman.
Thank you, Senator Toomey. Senator Reid from Rhode Island is recognized.
Thank you, Mr. Chairman, and thank you, Madam Commissioner and Director. In May 2021, the GAO released a study about challenges that insurers and policyholders face in an evolving market for cyber insurance. Director Seitz, can you explain the key challenges that GAO identified with respect to pricing cyber insurance and ensuring that policies provide appropriate coverage?
Thank you, Senator, for your question on that topic. We have closely reviewed the GAO study and contributed to it, and we agree with the conclusions in that study. I think in particular, looking at some of the pricing challenges and price increases that have been happening for the sector. Additionally, you're seeing some of the carriers withdraw coverage from certain parts of the market. I think in particular, an area of focus for our office as we administer the Terrorism Risk Insurance Program is the extent to which cyber coverage is available to small and medium enterprises. I think in particular, we've collected information for the first time last year regarding the extent to which SMEs can access that coverage. And that's going to be a priority of our work going forward, and additionally, an aspect of the work that we're doing with CISA regarding the catastrophic backstop for cyber insurance.
At this point, just for clarification, terrorism insurance, would that include cyber attacks, or is that sort of a function of the type and degree of the attack?
The Terrorism Risk Insurance Program does cover cyber insurance written in the TRIP eligible lines of insurance. And with regard to our work in that area, it's an issue that we've discussed extensively in our prior reports, particularly looking at how the certification provisions under TRIA would apply to cyber events when you're looking at issues of attribution and elsewhere.
Thank you. Commissioner Birrane and Director Seitz, how are NAIC and FIO respectively working with the insurance industry to address these challenges of cyber insurance? And every day there seems to be a new dramatic challenge presented by cyber or something. So this is the beginning, not the end of our discussion. Madam.
Thank you, Senator. I would say with respect to the NAIC, the first thing that we've done is develop a cybersecurity supplement by insurers for insurers' annual statements so that we can track very closely and gather information about insurers who are writing cyber insurance coverage in the U.S. We utilize the data that we've captured within this cyber supplement to monitor the risk and monitor what's happening in the markets. I think what we can confirm is that between 2020 and 2021, there was an increase of approximately 75% in direct written premium, but it's very clear that growth was due primarily to pricing increases rather than additional coverages. And so our data confirms that along with an increase in the frequency and the severity of cyber attacks and the number of cyber claims that are continuing to increase, premiums are going up, limits are going down. It's a much harder underwriting environment. I would say with respect to the market as a whole, we are actively engaged in efforts to look at what is the appropriate backstop, how do we make sure that there is a robust financing mechanism available, even in the event that the insurance market does not have the appetite to cover all of it.
Director Seitz, any comments?
No, I think Commissioner Birrane said it well. Thank you.
Commissioner, you clearly point out the increasing prices of cyber insurance, which obviously affect every business, particularly small businesses, municipalities. And what steps can the state regulators take to try to reduce those premiums and ensure coverage is available?
So insurance is fundamentally based on risk. So pricing is based on risk, and insurers engage in risk-based pricing. That's what we expect them to do. And so as risks increase, so do premiums and costs. We have switches that we can toggle in terms of opening up markets like the surplus lines market or captive arrangements for certain companies in certain circumstances. But at some point, there are risks that are very high. They are either too large or they're too volatile or they're too certain to be able to be as affordable as we would like them to be. I would point out that what we see happening in the market, in the tightening of the market, the increasing costs and the increasing underwriting standards also creates a discipline. It also helps with good cyber hygiene. So part of what it does is it asks businesses to themselves be more responsible in terms of taking their cybersecurity risks seriously. And as companies pair with insurers to do that and mitigate and reduce their risk, then that allows their programs to be more affordable.
Thank you very much. Thank you, Mr. Chairman.
Thank you, Senator Reed. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman, and thank you to both of you for being here with us today. As you are both aware, in response to the development of the proposed international capital standard, Team USA proposed the aggregation method as an alternative framework. However, comments filed in response to a recent IAIS consultation on the proposed criteria to determine the comparability of AM and ICS, it indicates that the current process may very well be biased towards the ICS and will likely preclude a finding of comparability for AM, which we used or which we want. Could each of you just take a minute and explain why a Euro-Centric capital model would have a negative impact on consumers' access to the U.S. insurance products? I'm assuming that both of you feel that that may be the case, and I would begin with Commissioner Birrane.
Sure. Thank you, Senator, for the question. So the U.S. market includes a number of foreign-owned insurers with U.S. businesses. So comparability would allow a foreign jurisdiction to defer to U.S. capital requirements for that business. So it encourages that business. Additionally, as U.S.-based insurers seek to operate abroad, it's important that those countries recognize relevant aspects of our system. I'd also just point out that the covered agreements between the U.S. and the EU and UK, along with our qualified jurisdiction process, already require recognition of U.S. group capital. So the IAIS process should really not seek to contradict that recognition.
Thank you. Director Seitz?
No,
I made the assumption, but I'm assuming that you're in agreement with my statement that we really do want to maintain the current aggregated proposal that we use in the United States today.
No, thank you, Senator, for your question on this issue. It is one that is critically important for the U.S. insurance sector, and it's one that our team has been working on for the last several years in close coordination with the NAIC, the states, and the Federal Reserve. We believe it's critical that we remain engaged in this conversation for many of the reasons that you noted. In particular, the international community is moving ahead with the development of the insurance capital standard, and we need to be at the table to improve that methodology so that it's more compatible with our U.S. system. As we discussed earlier, the ICS does not appropriately reflect certain aspects of our regime, particularly for those long-dated, long-duration products, which are critical for millions of Americans entering retirement. And I know that it'll be a priority issue for us over the coming months, and we look forward to working closely with the states, the NAIC, and the Fed as we take this important work forward.
Thank you. I really do believe that the U.S. system of state-based insurance regulation is truly the gold standard when it comes to protecting our insurance markets and the insurance consumers in my home state of South Dakota and across the country. Commissioner Birrane, do you believe that our state-based regulatory system has been effective and successful?
Very much so. I think it was interesting, as Senator Brown referred to AIG, and I think that for those of us that lived through that period of time and, the crash of the capital markets in 2008, what we know is that the one set of companies that did extremely well were the insurance companies, the P&C carriers that were regulated by the states. So as AIG sought to recover, it was those companies, those assets that they were able to sell in order to fund that recovery. So the place where state regulation is in place, I think we've demonstrated over time. We talk about life insurance companies and we talk about the safety of life insurance companies. The insolvency of a life insurance company is almost unheard of. And the notion that policyholders in those rare instances where there have been an insolvency are not getting paid is also unheard of. So I think that what the state-based regulatory system has proven over and over and over again, having just come through a pandemic, having just come through a very difficult environment, having all of the things that are going on in our society right now, and yet the state insurance system is protecting policyholders, claims are being paid, and so I think that it is infinitely clear that the mechanisms that exist at the state-based level are able to protect policyholders and respond quickly and nimbly to changes in circumstances that warrant additional and adjustments in how we regulate.
Well, Commissioner Birrane, I couldn't agree with you more, and I really do believe that Congress should allow you and the NAIC to do your job, and I think it's imperative that Congress recognizes that it has worked successfully, and that when we start talking about the other items that are critical, and one of the items on it is private equity, there are some very good messages out there about what private equity has done for the insurance markets in the United States as well. My time has expired, but I thank you for being. I thank you both here for your answers today. Thank you, Mr. Chairman.
Senator Menendez is recognized from his home or his office. I don't know where he is. Senator Menendez, remote.
Thank you, Mr. Chairman. Last year, I introduced the clarifying law around Insurance of Marijuana Act, or the Claim Act, have provide a safe harbor for insurers to provide products and services to businesses that are involved with state legalized cannabis without the risk of federal prosecution. This bipartisan legislation was included as a provision of the Safe Banking Act, which I strongly support. Commissioner Birrane, can you please describe why we need the Safe Banking Act enacted as soon as possible?
Thank you, Senator. As you know, the NAIC does support the Safe Banking Act. Insurance regulators recognize state legalized cannabis businesses require access to insurance to mitigate the risks that they face like any other authorized business. The Safe Banking Act would help remove federal barriers for insurers to insure state legalized cannabis businesses. It's really critical that businesses be able to buy insurance, that they be able to pay for that insurance, and when claims occur, that insurance companies be able to use the banking system to pay those claims. The Safe Banking Act would allow that to happen.
Thank you. I'm concerned that businesses that have nothing to do with cannabis could face serious consequences to the bills enacted. Imagine a scenario where a New Jersey light bulb manufacturer sells a product to a state legalized cannabis business, and there's a fire related to the light bulb, causing the business to suffer loss. Under current law in the scenario I just described, Could the light bulb manufacturer insurance company face federal charges if they paid the claim?
So the challenges that insurance companies have is using the banking system to transfer funds to a cannabis business. So the answer is that that is a circumstance which could be challenging for that light bulb company's insurer in trying to use the banking system to pay money to the cannabis business.
Well, the House has passed this bipartisan measure 7 times, and I think it's long past for the Senate to do the same. Let me turn to pandemic risk insurance. When COVID-19 first hit our country in 2020, small business owners discovered the most business interruption policies excluded claims from viral contamination, disease, or pandemic, leaving many businesses without relief. Instead, Congress quickly provided, on a bipartisan basis, trillions of dollars in aid to help keep small businesses afloat and save jobs. I'm proud to have voted for the American Rescue Plan, which was critical to our COVID response. But we should be planning ahead to get to better protect our economy from the risk of a new pandemic that could threaten to overwhelm the health system. In today's interconnected world, the question of the next pandemic is not if, but when. Commissioner Birrane, is there still limited pandemic business interruption coverage in the market?
Yes, I would say that the scope of coverage that's available in the market has certainly not changed. It certainly has not expanded.
So, wouldn't business owners, employees, and the federal government be better prepared for the next pandemic if Congress established a public-private insurance solution to provide coverage for pandemic-related losses?
I think that business interruption insurance in a circumstance like this is an area where the risk is potentially so large and so uncertain that it is not going to be covered by the private insurance market. And in those circumstances, it's certainly appropriate to discuss what public-private partnerships could do in order to make sure that financing is available in those extraordinary catastrophic circumstances.
I appreciate that. It's critical that we plan ahead for the next pandemic rather than wait until the next outbreak of a new deadly virus. And far from incentivizing lockdowns, what we really need is to find a way to incentivize businesses to preserve the lessons of COVID and accept a level of personal responsibility if they're unwilling to do so. And similarly, I don't know those who would simply wait until a crisis point and have the federal government distribute trillions of dollars instead of working ahead of time to develop a more targeted response to the specific needs of an individual business. That's what I think we should do. Finally, Mr. Chairman, last month, FEMA reported that over 425,000 policyholders dropped out of the National Flood Insurance Program since Risk Rating 2.0 took effect. That's nearly 10% of the program. FEMA originally estimated in a pessimistic model that 20% of the policyholders would drop coverage over 10 years. The agency predicted it would take years for 425,000 policyholders to drop coverage, but instead it took 8 short months. A majority of homeowners across the country are already uninsured against flooding, and it's clear that Risk Rating 2.0 is only making the situation worse. I think FEMA has misled us, and I want to work with you, Mr. Chairman, to advance the bipartisan legislation we have before the problem gets even worse.
Thank you, Senator Menendez. Senator Tester from Montana is recognized.
Yeah, thank you, Mr. Chairman. I want to thank both the folks that are here in front of us today for testifying. I want to touch back on cyber a little bit. Commissioner, is there anything that Washington, D.C., Congress or the executive branch needs to do to deal with cyber from your industry perspective, or are we okay where we're at?
So, Senator, are you speaking in terms of the protection gap?
I'm speaking in terms of the threat, and I'll get into the increase in premiums due to cyber. Or is there anything we need to be doing to put forth some relief? I'm not talking about writing checks out to people. I'm talking about making policies that will make cyber more manageable, cyber threats.
Sure. So I think from the perspective of our industry is we're looking at assuring that there are adequate controls in the insurance industry so that they can withstand potential cyber threats. What the NAIC has been engaged in is, of course, we've developed a model law, which states continue to adopt. Now 80% of the market has adopted or subject to those laws, which improve and increase the security of data and the rapidness of notice to insurance commissioners about when there has been a data incident. We continue to strengthen and update our guidance for financial examiners.
But
Yep.
so what I'm hearing you say is that between NIC and the state governments, that the issue is being handled adequately.
We believe that we have an adequate framework in place to assure that insurance
Okay.
companies' insurance data is protected.
Okay, you'll have to correct me if I didn't catch this right, but when Senator Reid was asked the questions, you said there was a 75% increase in premiums due to cyber?
Right, so on the one hand, we talk about what insurance companies are doing to make their data safe.
Yep.
When we talk about then insurance companies as risk financiers, so when they sell policies,
Yep.
policies have certainly become more expensive for the businesses that buy those policies.
And that is taking what kind of time frame, the 75% increase?
That's over about the course of a year,
1 year.
1 year.
Do you, the ranking member talked about you guys dealing with risk, long-term, short-term. Have you guys done that with issues around climate? Let me give you an example. Where I live in Montana, it's a big state, but where I live in Montana, it's dry as hell. A few months ago, you probably heard about the flood that came out of Yellowstone Park that was a 500-year event. It seems like we're having a 500-year event and 100-year events every decade. So do you guys take that into account?
So we certainly track very closely the frequency and the severity of perils and
Yes.
claims. So for example, in the world,
Yeah, go ahead, keep going real
I was going
quick.
to say, in the world of climate
Yeah.
specifically, we know that weather patterns are changing and that those weather patterns are causing increased
Yeah.
claims activity, et cetera.
No doubt about that. Can you give me any kind of an idea, just from a property damage standpoint, what the increase in premiums have been because of that?
I have to tell you, I don't have the numbers at my fingertips, and I'm happy to follow up to give you those numbers, but the increases are exponential. So we are seeing much, much larger numbers of claims. You know, weather events are more frequent, they're more severe, and
I would love to get those numbers.
Absolutely.
Because there are a number of folks in the body, in Congress, that think ignoring climate is something that will make it go away, when in fact, my experience on a farm in north central Montana is it ain't going away. It's, in fact, getting far worse. I mean, last year was the worst crop we ever cut. This year was the second worst crop we ever cut. And I know I look very young, but we've been on the farm for 45 years. So this is pretty insane. I want to talk really, really quickly about NARAB. This is the damnedest thing I've ever seen, because we passed a bill years ago, and quite frankly, we still don't have, we don't have a board, didn't have it through Obama, didn't have it through Trump. Number one, could you just give me the benefits of that NARAB board?
so I feel like that's an issue that we would probably do better briefing you on afterwards in terms of the board. But, you know, the NAIC's position has been that the board should be created and established.
Can you give me any update on, Director Seitz, give me any update on the status of that NARAB board being
No,
fully functional?
No, thank you for that question. We share recognizing the importance of NARAB, and it's an issue that we've been meeting with a variety of stakeholders on, particularly on the broker community, to sort of think through that process again. And it's an issue that we've been focused on for the last few years in our office of trying to move that forward.
Well, and I'm way out of time, but I would just say, please be aggressive. You know, bounce some people around, do whatever you got to do, get this damn thing done. It would be, I think, a win for the consumer, a win for the industry, and a win for the administration. Thank you. Thank you, Mr. Chairman.
Thanks, Senator Tester. Senator Haggerty of Tennessee is recognized.
Thank you, Mr. Chairman. Ranking Member Toomey, thank you both. And to our guest, thank you for being here today. Commissioner Birrane, I'd like to turn first to you. There have been a number of concerns raised about the lack of regulation and transparency with respect to private equity-backed insurers. I'd like to talk with you from a state regulatory standpoint. My question is, are insurers that are affiliated with private equity firms treated any differently than other insurers, and are they somehow able to avoid oversight at the state level?
No, Senator. Private equity-owned insurers are not treated any differently than other insurers, except to the extent that it has been the common since about 2013 that states have actually imposed greater requirements on PE firms that purchase insurers. So they're generally been required to accept additional conditions and reporting obligation as a condition of the approval of their investments and their investment in an insurance company. So those stipulations are now part of the financial analysis handbook that states use when they assess a request by any entity to purchase an insurance company. I would also say that more recently, in light of an increase in PE ownership in life insurers and the complexity of some of their investments, and investments not just made by PE-owned insurers, but by life insurers generally, the NAIC's Macroprudential Working Group has constructed a list of 13 specific regulatory considerations that are focused on investment disclosures, ownership and collateral, reliance on rating agencies, fees, and pension risk transfer guidance.
Got it. I want to come to pension risk transfer in just a minute, but I want to be clear again. You said that there are actually additional regulations, an additional layer of regulations in place for private equity-owned insurers at the state level.
That has been the standard that has been employed by most states.
Thank you. Back to pension risk transfers. That's another topic I wanted to discuss with you. That's the process by which a corporation might transfer its pension risk to insurance companies. What tools do state insurance regulators have to ensure the protection of policyholders in that instance? And are they any less safe once the pension has been moved to an entity that's regulated by the state insurance regulatory system?
So the insurance regulators have a very robust set of tools because we are the primary regulators of the financial solvency of insurance companies. And our system is designed to avoid failure. Our system is designed to have tremendous optics into the financial standing of those companies. We use a variety of tools to assure that companies maintain the reserves that they need, particularly with life insurers that have very long-term risks, so their annuity obligations, their life insurance obligations, to assure that they are adequately reserved. So we have all of those systems in place. The fact that a PE company owns that insurance company doesn't change any of that.
I wouldn't have thought so. Ms. Birrane, I want to stay with you for a little bit longer. As you know, in May, the National Association of Insurance Commissioners sent a letter to Chairman Brown responding to several questions that he posed on the topic of alternative asset management companies and the life insurance sector. In NIAC's response, they laid out pretty clearly that state regulators, quote, possess the tools and resources necessary to address Chairman Brown's concerns. I want to reiterate my support for the role of states as the primary regulators of the insurance industry. And like any other industry, life insurance will continue to evolve. And over the long run, I'm certain they'll provide new and better products as they evolve to consumers. And it's clear from NIAC's letter that state regulators have the tools they need to continue in this role. Would you agree with that?
Yes, I would agree with that.
Thank you very much. I appreciate it. Thank you, Mr. Chairman.
Senator Warren of Massachusetts is recognized.
Thank you, Mr. Chairman. So, not content with buying up hospitals and newspapers and single-family homes, retail chains, and pretty much everything else under the sun, private equity has now set its sights on a new moneymaker, Americans' retirement savings. Over the past decade, private equity has hoovered up companies that sell life insurance and other retirement products. And today, private equity firms control more than 10% of all life and annuity assets in the United States, despite having had almost zero presence just over a decade ago. Now, these new private equity-owned insurers have developed a particular taste for workers' pensions. Under this model, called the Pension Risk Transfer, or PRT, transaction, private equity giants like Apollo are buying up pension obligations from big employers like JCPenney and Lockheed Martin and Alcoa. At least 300,000 Americans today have pensions that are managed by private equity firms. Mr. Seitz, you run the office inside the Treasury Department that oversees insurance products. So I want to ask you about the safety of these Americans' pensions. So let's say someone retired from a company like JCPenney or Alcoa, and their pension was transferred over to Athene, Apollo's insurance arm. Would you say that the retiree's pension is just as financially secure now that it's managed by a private equity owner insurer as it was before?
No, thank you, Senator, for that question. I mean, we share your view on the importance of this issue and recognize the importance of pensions to millions of Americans that are relying upon those for their retirement and a dignified retirement. And we are working closely with the NAIC and their regulatory considerations as they look at their framework and how to best address not only changes in the PE sector, but also, as Commissioner Birrane mentioned, more broadly in the life insurance sector with regard to their investment and liquidity.
Well, I appreciate that you care about these issues, but that's not the question I asked you. I asked you, once there's been a transfer to Apollo's insurance arm, are the people who are covered just as secure as they were before the transfer? That's easy. Yes or no?
You know, the individuals, when their policies are transferred, as Commissioner Birrane mentioned, they're covered by the individual state guarantee funds, and it's an area of focus for our office to make sure that the state system is being, regulatory mechanisms are being designed appropriately to reflect these new transactions, and we appreciate.
I'm still not hearing a yes or no. You know, just to make clear, in a September 2021 report, the Federal Insurance Office, which you run, stated that, quote, PE owners may use investment strategies for their owned insurance entities that have heightened credit and liquidity risk profiles as compared to other market participants, end quote, and, quote, tend to hold a more significant proportion of investments in alternative or non-traditional insurance assets that are associated with illiquidity and complexity premiums, end quote. You still agree with what you said?
No, thank you, Senator. We have articulated those same points in our letter to Chairman Brown a few months ago, and it's an issue that we are focused on in our office, and we appreciate the changing investment portfolio of those companies as well as across the broader life insurance.
All right,
sector.
in other words, there's more risk.
It's an area of increased focus for our office, and we're looking forward to.
Look, exposing Americans' retirement savings to more risk is exactly how private equity makes its money. Riskier and more complex investments mean that private equity-backed insurers can jack up their returns and their short-term profits. But the pensions are more vulnerable to being wiped out by a market downturn, which endangers the insurance company's insolvency. This is not hard. This is just how the pieces work. For example, 1/5 of Athene's portfolio is invested in risky asset-backed securities and leveraged loans made to companies that are already highly in debt. And even worse, many of Athene's risky investments are created or managed by the parent company, Apollo itself. This means that Apollo collects fees on the investments that it directed its insurance arm to make. So look, this is a problem of more risk, and the risk is borne by people who have invested for all their working lives in their retirement security. And I want to underline the word security. My Stop Wall Street Looting Act would strengthen private equity disclosures to empower investors and help regulators crack down on self-dealing. But we also need federal and state insurance regulators to step up and address the risks that private equity poses to pensioners and workers. I appreciate that Treasury and NAIC are looking at this issue closely, but enough studying. It is time to act. And I'm looking forward to working with both of your offices to ensure that happens. Thank you, Mr.
Thanks,
Chairman.
Senator Warren. Senator Moran from Kansas.
Chairman, thank you. Chairman from Ohio, thank you. Let me start with you, Director Seitz. Concern has been expressed by you and some of my colleagues about private equity firms, however that term is defined, having a short time horizon for their investments in insurers and thus may be willing to engage in riskier activities. Can you tell me if there are insurers that have been purchased by private equity that have been sold or up for sale, indicating a quick turnaround?
No, thank you, Senator. It's an issue that we are closely monitoring, particularly over the last, I think as Commissioner Birrane mentioned, we've seen an increase in activity over the last several years in this area, and particularly for certain blocks of business, and it's an area that we're continuing to monitor.
The question, though, was, are there examples of where insurance companies purchased by private equity are then in a short fashion sold?
No, I mean, I don't want to speak to any specific transactions, but I think generally what we've seen is they are not, making those types of movements that you described.
Thank you. I do want to indicate that my experience in Kansas is a PE firm's purchase of insurance companies has turned out to be very valuable to that company, to those companies, and it benefited the company and its employees with an influx of capital that fueled growth and additional jobs and helped those insurance companies continue to be in existence and to grow their book of business and their economic activity in our state. And then I was listening on the television about, from my office, about a question that the ranking member asked. It does seem to me this administration is determined to import financial regulations and capital standards from Europe as quickly or as pervasive as they can. My view is that we need that we do not need the importation of European policy dictating American business and markets, and that the FIO's top priority should be defending American interests in preserving a system that has worked so well, as I heard you indicate, of state regulation over a century in those. You ought to be promoting that in the international forums. And I wasn't quite certain that you answered Senator Toomey's question, but I would add my thoughts to that topic. Thank you.
Thank you, Senator Moran. Senator Sinema is recognized, I believe, from her office. Senator Sinema of Arizona.
Thank you, Chairman. I appreciate this. I want to start by talking to our witnesses about our working group that I convened last year, a bipartisan Senate working group with other members of this committee to identify and advance solutions around risk sharing and future pandemics. Our goal is to improve the resiliency of the U.S. economy to future pandemic-related economic shocks. Our group aims to do this by creating and advancing an insurance framework that brings forward the power of the private sector and provides business owners with choices to buy coverage that aligns with their needs and their risk tolerance, that will reduce the price tag of any future pandemic response and address some of the waste, fraud, and abuse that we're seeing with respect to pandemic aid. Our response to future pandemics needs to be leaner, faster, and smarter, and it's important to me that future responses are more fiscally responsible, as it's clear that the risk of overspending, coupled with supply chain disruptions, can trigger an inflationary response. So first, to Commissioner Birrane, I appreciate you joining us today. As you know, for insurance policies that cover event cancellation and business interruption, virtually all of them include an exclusion that exempts pandemics from coverage. Despite this exclusion, I've heard from businesses and insurance brokers alike that event cancellation and business interruption coverage is increasingly difficult to find, and it's expensive if you can find it. What do you see in the market for these lines of insurance?
Well, I think your characterization of the current market condition is correct, and I do not see that changing in the near future. I think that there are certain types of risk that are, as I've said before, too large, too volatile, too certain for the market to be able to absorb them.
Thank you. Our working group is concerned about this because we want businesses to be able to find and afford the insurance policies they need to qualify for financing and to responsibly plan for the future. So my next question is also for you, Commissioner. For a future pandemic, I'd like to also see an insurance solution for small businesses so that they can take a level of responsibility that aligns with their risk tolerance. In 2020, some Arizona businesses had to wait months to get their PPP loans, and they had to go from bank to access relief. I'd rather have a framework where businesses could purchase subsidized coverage, where it's affordable to the business owner and the business owner knows exactly how much coverage they're getting. Would you agree that a pre-established private insurance policy would generally provide faster and more predictable relief for businesses to plan around?
Well, what I would suggest is that, you know, the NAIC has supported the idea of a federal backstop of sorts with respect to BI coverage. And certainly it is important that business owners have a sense of certainty about, you know, what their coverage options are and what their costs are. There are a variety of models that work well when the government and private industry couple together. That draws on the strengths of each, the strength of government to be able to fund more broadly and the strengths of insurance companies to be able to appropriately underwrite and price and adjudicate claims and assist businesses in risk mitigation. So I would say overall, there is a case here to be made for such a partnership, and the particular model of that partnership is something that the NAIC does not really have a position on.
Thank you. And would you agree that the risk management and auditing capacities that private insurance brings would be helpful in reducing waste, fraud, and abuse in a future pandemic?
I would certainly say that insurance companies, part of what they bring to the table in any circumstance is expertise in underwriting and in risk mitigation, as well as risk financing and fraud detection.
Thank you. Now I have a question for you about insurance more generally. In your experience regulating insurance companies, would you say that an insurance carrier bearing some level of risk incentivizes them to conduct more robust auditing and risk management since their own capital is on the line?
I would say that insurance companies are generally very effective at reviewing risks and in helping their insureds to mitigate those risks. So that is certainly part of when you have an insurance policy, particularly in the property and casualty area, or workers' compensation, the insurance company often plays a very integral role through the underwriting process and the pricing process in helping companies to mitigate the risk that they're trying to finance.
Thank you. And finally, I'll just say we are working to identify a thoughtful and bipartisan federal solution to address this issue and create a smarter response for future pandemics. Our working group appreciates the National Association of Insurance Commissioners' strong leadership in endorsing a federal solution in this space, and I'm looking forward to working with you and other key stakeholders to find a path forward here. So thank you, Mr. Chairman. I yield back.
Thank you, Senator Sinema. Senator Van Hollen of Maryland is recognized.
Thank you, Mr. Chairman. Thank you to both of our witnesses here today. And Commissioner Birrane, it's great to have a fellow Marylander here. Thank you for your work protecting the interest of Marylanders and your work at NAIC. And I also want to thank you and NAIC for helping me and some of my colleagues prepare legislation to protect seniors from financial fraud. The legislation is entitled Empowering States to Protect Seniors from Bad Actors Act, and it would provide an authorization grant program to the SEC to provide both state securities and insurance regulators with additional resources to crack down on fraud, which we know is a huge problem, $3 billion a year, at least in financial scams. Can you just speak briefly to the importance of passing this legislation to protect seniors from financial fraud?
Absolutely, Senator. We've been very happy to work with you on that initiative. I mean, there's probably consumer protection is what insurance regulation is all about. And there's probably no more important area of consumer protection than assuring that our seniors are not subject to aggressive marketing tactics and to other fraudulent practices. So it's really critically important that we have all the resources available to assure that we are on the ground working with seniors directly to be able to prevent them from being caught up in fraud.
Thank you, and I'm going to take this chance to ask the chairman and the ranking member to join us in getting that bipartisan bill out of the committee.
Senator Van Hollen, we were just speaking about it quietly while you were asking.
Thank you. I appreciate that. Thank you.
Thank you.
Thank you. Let me ask you a couple questions regarding capital standards in the context of climate risk. As you well know, an important role of a state insurance regulator is to monitor the capital adequacy of insurers to ensure their ability to pay their claims following catastrophic events. One of the concerns is that with increasing severity and frequency of extreme weather events, that the risk-based capital models may overemphasize the trends of older historical data and not adequately assess newer risks. So two-part question, Commissioner Birrane. What is the NAIC doing to ensure that its models incorporate the most recent and relevant climate data in order to reflect the true risks? And secondly, from a risk management and capital adequacy perspective, how important is it for insurance regulators to have standardized comparable data on climate risk?
So with respect to the first issue, I would say that what our solvency workstream is doing and what our E-committee is doing is working very closely in making sure that our models are accurate and are up to date, and we are adding additional perils to the RBC capital framework to assure that we capture more broadly the various events that can occur. So that's the first thing. And secondly, with respect to data collection, the NAIC has a rigorous process of data collection that we think captures what needs to be captured. And that is something that's subject to constant update and improvement. So we have, both on the individual state level and in the aggregate through the NAIC, the ability to capture data in a way that insurance regulators use that data to understand what are claims patterns and where claims are occurring and why and how claims are being paid and what the impact of that is on the solvency and the financial status of entities.
So is there an effort to create some kind of national standard so that states are not using 50 different standards for this purpose?
There is conversation through our Center of Excellence on the development of a single standard and being able to work through with insurance companies what would be appropriate in that regard. So that is a conversation that is occurring as to whether a centralized and standardized approach is the one that makes the best sense. But I want to assure you that in the interim, the data collection that occurs around natural disasters and in terms of insurance companies is very robust.
Thank you. Mr. Seitz, I don't know if you want to, in my remaining time, just comment on those two parts of that question.
No, I would just say we share your view on the importance of consistent, comparable, and granular data. I think particularly for our office, we're looking at it through the lens of the availability and affordability of coverage, particularly in the homeowner's business line. And it's an area that we've seen a need for some national standards and approaches to.
Thank you. If you could just get for me, we've obviously seen a huge increase in losses, property losses, due to extreme weather events over the last couple decades. There have been a number of reports. If you could maybe try to quantify for me and the committee what the increased premiums have been as a result of increased climate risk. I realize that's an imperfect science, but I would like a ballpark estimate if you could get back to us on that. All right? Thank you.
Thanks, Senator Van Hollen. Senator Cortez Masto from Nevada is recognized from her office.
Thank you, Mr. Chairman. Thank you to the two speakers today. First, let me at the very beginning show support for Senator Menendez's line of questioning around the Safe Banking Act. Safe Banking Act is about supporting small businesses in this country, which are the backbone of our economy, and it is bipartisan, has a bipartisan support. I think it should be passed. So I hope my colleagues feel the same way. Mr. Seitz, Director Seitz, let me talk to you a little bit about the Federal Home Loan Bank review that is happening. The FHFA recently announced a thorough review of our nation's federal home loan bank system. My first question to you is, are you aware of the proposed review? And if you are, I really have a question about whether the Federal Insurance Office plan to monitor or participate in the review of Federal Home Loan Bank's review is going to happen as well. Let me just put this out there. It was surprising to me to realize that 548 insurance companies are members of the Federal Home Loan Banks and that they receive about 1/4 of the advances. So I'm curious if your organization is going to be reviewing and following what the FHFA is doing.
No, thank you, Senator, for that question. The federal home loan banks play an important role in our housing markets, and we are very well aware in FIO that insurance companies, particularly life insurers, are increasing participants and have taken significant advances from the FHLBs. It's an area that we have been discussing with our colleagues at the FHFA, and we look forward to continuing to engage with them as they begin the review process, which just recently started.
Good, thank you, and I hope you do. I hope you do continue to monitor it. Let me jump to an issue that my colleagues have been talking about, which is private equity. But before we get there, I want to follow up on business interruption insurance. Mr. Seitz, in March of 2020, when the COVID-19 pandemic began, my office received calls from business owners who had bought insurance. They chose policies that included business interruption insurance, and they paid their premiums. Then when the pandemic hit, they had to close down due to a risk of contamination, obviously, but they were not covered. So I guess my question to both of you is, and you talked a little bit about it, is it feasible for insurance companies to provide pandemic insurance? That's one. But then two, when it comes to private equity, Ms. Birrane, let me ask you this, because you talked about, in particular, the transfer of ownership or risk from private equity to insurance companies. And one of the things you identified is that there are certain types of risks are too large and too volatile for the market to absorb them. But you don't feel that way about private equity as they come in and purchase so many unfortunately, insurance companies and have so many assets. So, and I know I'm asking and conflating two questions, but they are similarly related, and this is the concern. If insurance companies are not covering the risk when there's a pandemic, even though companies are paying for it, if there is some risk related with private equity, and there is, God forbid, some disaster economically, how can we guarantee that that coverage will exist by insurance companies as well? Is there a correlation between the two? Do you not see that, or do you feel that protections have been put in place, as you say, Ms. Birrane, by the NAIC adopting these new regulations when it comes to private equity? And maybe let's start with you.
Sure. So what I would say is, let's think about this as a matter of contract. So when you think about the business interruption insurance that was baked into policies that were purchased by businesses, those contract terms actually, for the most part, exempted business interruptions that are caused by things like contamination, that would fall within a pandemic, or that didn't result from a physical covered peril. So from a contract perspective, those gaps in coverage were baked into the policies, and unfortunately, many business owners were not really aware that those limitations existed. If we look at private equity as a general matter, I would come back to the notion that the private equity firm, as an owner of the insurance company, does not run the insurance company in the same way. And insurance companies are subject to a set of very clear rules and guidelines around what insurance companies can do, from the kinds of investments that they can make, to the credit they get for those investments, to the risk-based capital standards that are in place. None of those are different because the owner is a private equity company. So we continue to monitor and regulate the performance of the company regardless of the ownership. So hopefully that helps contrast those two circumstances.
And I know my time's running out, and thank you for that. That's very helpful. But Director Seitz, do you feel the same way with respect to private equity companies, that they can be adequately protected by additional conditions or these 13 new regulations that NAIC has adopted.
No, I mean, we appreciate the importance of retirement security products for millions of Americans, and we are working closely with the NAIC in the states as they develop the regulatory considerations. And as our letter noted to Chairman Brown, there are certain areas of focus for our office, and also the extend, to the life insurance sector more generally, irrespective of sometimes the business models as well.
Thank you. Thank you, Mr. Chairman. I know my time is up. I appreciate it.
Thank you, Senator Cortez Masto. Thanks, Commissioner, and thanks, Director, both of you for answering questions forthrightly and being here today, and especially for your public service. I'd like to submit for the record the testimony of Colleen Rydell, a retiree from Quest of the Northwestern Bell Telephone Company, a member of Communication Workers of America, whose pension is now administered by Athene. For senators who wish to submit questions for the record, those questions are due 1 week from today, Thursday, September 15th. You would be getting those. To the witnesses, please submit your responses to questions for the record 45 days, no more than 45 days from the day you receive them. Thank you again. With that, the hearing's adjourned.